series, we're growing a Robinhood account from $0 all the way to 1 million. And I'm showing you every step of the way how I get there. This is what the account's currently at with our current positions. But really what I want to talk to you about today is a bit more in depth of what I call the cash flow method. That is similar to options wheeling. And it's really going to be the bread and butter of how we're going to grow this account. So right now we're taking a lot of risk. These are all our open positions. We are mostly a buyer of options, hoping that the price of the underlying moves in the direction of the option that we purchased. Right now we are short the market on the S&P 500, Bitcoin, MicroStrategy, as well as Palantir. So we hope those stocks go lower over the coming months. And if they do, we could maybe even double or triple the account balance during that time. But once we get to a solid bankroll, say around $20,000 to $30,000, then we can switch over to this cash flow method. And really what that is picking stocks that we want to own for the long term, that are going to go up on the long term, as well as continue to grow, have strong fundamentals, good leadership. We're going to look for all those things when we actually purchase the company that we want to own. But once we do that, to juice the returns, we will do what is called option wheeling. And really what that is you're going to be selling both puts and calls against that company and owning the underlying shares as well. So to start a position, usually you could use like a cash secured put. And I'm going to show you all examples for this, and I'll even put this document in the description below so you'll have it there. But you would sell like a cash secured put if you want to actually own the shares, usually around like a 30 to 40 delta, because it's going to be closer to the current share price and you want to get assigned, right? So you get to choose the strike that you want to own 100 shares of the company, and you receive a premium for the put that you sell. So ideally, if you want to own it, you actually want to be assigned. You want the price to go lower. You want to buy the shares at the price that you want, and you get to get paid for doing so. So it's a really effective strategy. The only downside sometimes is that maybe the stock keeps going higher. And in that case, you would just collect the premium on the put that you sold, and you would get to keep it, right? But you wouldn't participate in the share appreciation. So sometimes if it's at a price that you want to buy today, maybe it's better just to buy the shares. But if you think that it can drop a bit lower and you want to actually own it at a lower price, then using the cash secured put method is a great way to do so. And if it's a stock that maybe you don't want to own, but you think that, maybe it's oversold and it's going to bounce from here, and in that case, I would usually sell like a 20 to 30 delta. So like a bit further away out of the money. That way you are in less danger of being assigned. And then that way you can just collect the premium on an oversold stock or an ETF or any other asset. So that's really cash secured puts. You usually would do this like around 30 days out. You could even do it weekly if you want to. Obviously, weekly, there's a lot more volatility there, but like 30 days out is kind of like the sweet spot. And then same thing for covered calls, right? So say you get assigned on the company that you want to own, then you begin selling covered calls to generate premium, and you get to collect that premium. Usually, similar for this, I would probably be more around like this 20 delta, because if it's a company that I really want to own, I don't want the stock to blow through past the strike of the call that I sold, because then I'm in danger of actually losing my shares. Because when I'm the seller of a call option, I'm obligated to sell 100 shares of the underlying on that expiration date for that contract. So usually I'm looking at around 7 days, which these weeklies, if you sell weeklies, that's actually the best annual return. And I'm going to show you a bunch of examples as well. Or you can do 30 days out, monthlies, and typically anywhere between like 0.20 to 0.30 delta. So you're trying to take advantage of the share appreciation, but you don't want to lose your shares. So when you're in a cash secured put, you might actually want to be assigned. Maybe you don't if you're just doing a cash grab. And then if you're selling covered calls, typically you want to continue to own the shares of the underlying. And in that case, you want to have a strike that's further out of the money so you can participate on the share appreciation as well as be in less danger of actually losing your shares. So I'll flesh this out a bit more. This is just kind of my original thoughts, but I'll make this in a bit more organized fashion for you guys to digest. But let's get into an example. So if we go here and we look at a popular stock that has risen over the last year and a half is SoFi Technologies. This is a fintech company, and it's been doing really well. And you can see that for almost 2 years, it was just actually moving sideways. And you can see it was kind of basing around $4.50. It would finally made some lows back down there, came back down, retested it, and then it bounced to the upside. You can see here even a few times it broke out. You saw that break out, and then eventually it even crossed over this $8.50 level, which is a previous supply zone. It broke above, broke back down. But ultimately, if you were running this strategy and the stock was going sideways over time, you would be collecting premium on both ends of the stock and all these price movements. Then here it broke out above again, and then ultimately you can see here it kept going down to this point of control level around $6.50 to $7. And you can probably even see it here if we look at the overall volume profile. You can see it was at $7.30. So moving in this pretty broad range, $4 to $9, that's a pretty big swing. But ultimately, it formed a base, and if you've been following its earnings, it's been beating earnings over time. If we go into the financial statements, you can see even here, it's had pretty consistent quarter-over-quarter revenue growth. Even on an annual basis, you can see that it went from $1 billion to $3 billion in the trailing 12 months is $3.6 billion. And then I'm sure from a cash flow perspective as well, you can see that cash flow from operating activities has been increasing. And then, you could dig a bit more into the balance sheet as well as management and really understand, is this company a good stock that you want to own for the long term? Do you buy into their narrative? Do you believe in their story? And if you do, and the technicals look great, then this is a stock that you would want to start doing this method on, right? So the way that I would be thinking about if I actually owned 100 shares of SoFi, but let's just get into the math real quick of this because it is kind of scary how much money you can actually make. So if we look at SoFi, you can see here on the 1-year chart, it's gone up and to the right. If you were doing this method while it was sideways, you'd be collecting all the premium. And then once it actually started pushing to the upside, then you're in a lot better position to actually sell more covered calls and also take advantage of the share appreciation. But if you were going to own 100 shares of SoFi at $14, that would cost you $1,400. And then you would be able to sell one call contract against it. If I was thinking of just looking at weekly calls, I would want something a bit around 0.2 to 0.25 delta. So say recently you saw that there was a lot of weakness in the market. It's come down a bit. So you could probably be a bit more aggressive on selling those covered calls. This is more of an art form than a science. And the more experience you have, this will come somewhat natural to you because you'll know when the stock is overextended. Is it pushing above moving averages? Is it oversold? Do you want to sell more cash secured puts? If it's pushing too high, then you know that maybe I'll start selling some covered calls, maybe even closer to money because I know that it's starting to find some weakness and maybe it's going to have a bit more of a correction or a mean reversion back to the moving averages. So you got to think of all those different things, and I'll even talk a bit about that in a moment. But say we own 100 shares, or let's just say we own 1,000 shares today of SoFi. So that would cost us $14,550. Then we came in here and we saw that 8 days from now, January 17th, we could sell this 15.5 call for around $22, right? $22 per contract for 8 days away. So that's not too bad, right? So this was a 15.5 strike, 8 days away. We can sell 10 contracts because we have 1,000 shares. 1,000 divided by 100 is 10. The premiums per contract is 22 cents times 100. That's $22. $22 times 10 is $220. So in 8 days, our return on our invested capital, as long as SoFi is trading below $15.50, we will receive 1.5% return on our invested capital, which is just looking at how much we received and how much shares we had to buy. And then if you divide that by the number of days to expiration, you get 0.2%. And if you multiply that by 365 days in a year, you can see here that if SoFi just did nothing for a whole year, you could sell these 0.25 to 0.3 covered calls 8 days out. You could make 69% return annualized. So that's about 7 times better than what the S&P 500 averages over a year. So you can see that if you get better at identifying trends in the stock price and where it's overheating or where it's overextended or even oversold, then you can actually take advantage of this and collect all those premiums. And the stock price doesn't have to do anything. But if it does go up, then you also benefit from that as well. So you can make money on puts, on calls, and then share appreciation. And that's really the options wheel. But let's look at, say, like a monthly contract as well. So like 29 days out, February 7th, if we wanted to look at, say, let's go a bit more aggressive here. We'll do a 0.3 delta. I think the last one was like 0.27, but $17. And then if we really go back to the chart, so looking at the chart here, it did top out at that $17.21. We are starting to form somewhat of a downtrend. Maybe you could be a bit worried that this will bounce back to the upside, but what are the odds that by the 7th of February that it's going to be trading over $17? It's actually really low, especially with all the market weakness. And then if you want to get a bit deeper into it, you can look at Bollinger Bands, and you can see that this is the upper end of the Bollinger Band. So for us to bounce all the way up and over $17, that's highly unlikely. In 29 days, you could even look at moving averages. So you can see here that it's on the 50-day moving average, right? So it's really overextended above the 200-day. It's coming down to retest this 50-day moving average. So maybe I would like to see it bounce. So like maybe tomorrow, if the stock bounces, then I would consider selling some covered calls, because the covered calls, the premiums are going to go up when the stock is moving higher. Because the stock's been in a downtrend, all of those call contract premiums have dropped. So ideally, if you were owning shares of the company and it pushed up here, it hit this like 1650 level, then it came back up here, it tested 17, and then it dropped, came back up to around this 1660 level. You can see that it was kind of forming this like head and shoulders pattern. And when it came back up here and rejected, then you're pretty comfortable with like selling closer to in the money call contracts. You could also look at like MACD and see that it's been diverging. It's been heading lower on that first. You can see here on that first peak, it topped out here. There was a crossover as well as a crossover here. And then even when it got to new highs, it was still forming lower lows. So it was having this somewhat of a divergence in MACD. And so there you knew that strength on the buying side was starting to dwindle, and there was likely to be a reversal. So at this case, you would want to actually sell those covered call contracts and maybe be a bit more aggressive, because you know that there's a potential reversal at play. And then same thing with RSI. RSI is like, if it's over 70, you can see here that we're really stretched over and above current prices. And then this started to weaken, and it's kind of in confluence with MACD as well. So you knew that there was going to be more of a reversal and maybe this mean reversion. If we break below the 50-day moving average, we could even push even much further in the market as well, especially with how the S&P 500 is trading. So these are all like things I look for, and it's more of like an art than a science for when you're making these positions. So say, because we think that maybe, 16 and a half, maybe that's too, we really want to keep the shares. We don't want to do that. So let's look at like a 17, 30 days out, just in case there is a bounce to the upper end of that Bollinger Band. So if we sold the 17s, we would receive 50, well, no, I don't know why, but it looks like the limit price is actually much higher here than what's the chain. So say we would receive around 80 cents per contract. So here we would be $17. This was 29 days to expiration. We'll receive 80 cents per contract. So that's $800. Our return on invested capital is $550. And then our annualized ROIC is 69%. But the delta was a bit higher than the other contract in the weekly. The weeklies should always be a bit more returns, but it's really hard to manage those. Usually what I like to do is I will do the 30-day, and then around like a week or 2 weeks, if the calls that I sell get to around 60 to 75%, like 65 to 75% in returns, then I will just close out of that position, right? So if the stock falls further, maybe it's like really far away, I might just let it go to expiration and collect 100% of the premiums. But if I think that it's starting to get oversold, then I'll collect the calls, right? So I'll take in those return in. I think that it's going to bounce. If it starts falling a bit further, these call contracts that I sold are going to go in the money. They'll be up like 60, 70%. If I think that it's hitting a certain level of support, say around this $13.12, because you can see it bounce from there previously, then I would actually close out of that position, because I think that there's this going to bounce to the upside, and then I would appreciate again on the shares, as well as maximize the returns on the covered calls that I sold, because I'm on the other end of it. I'm the counterparty risk. So in that case, I would just take profit on those because I think it's going to bounce. So this is kind of like the bread and butter of the strategy, right? And you can see that you can make a great annualized return by doing so. But it still takes a lot of knowledge of trading, not only picking the company and knowing that it's going to go up over time, especially in like a bull market. This might be really difficult right now because there's so much volatility going on, and we could have a bit more of a drop in the markets. But you should be excited for that, because if you are new to this, you can start buying really quality companies. Just like a quick list of things that I'm looking for is like AMD. We talked about NEO. Celsius could be one. I'm a bit iffy on that. We could also look at Amazon at some point if it really sells, because Amazon's such a great company. I still think it's going to be like a $3 trillion market cap at some point. AMD has sold a lot. This one's going to be at a pretty hefty discount in the coming months. NEO could sell a bit more, but I'm really bullish on the company overall. It's also a bit of a riskier play because it is a Chinese company, but I do like the owner and the fundamentals. And then you could also do this on stocks that really just anything that has a lot of option liquidity. And what that is like if I went here into SoFi, you could see that there's like 286 volume on this February 7th date. The third Friday of every month is going to be the most volume and the most open interest. So you can see there's way more open interest, way more volume. And that's just because it's the monthly expiration. So you always want to check, though, with whatever stock that you pick, that there's a lot of volume and open interest and liquidity for you to actually sell options against it. Like Riot's a good one. A lot of these Bitcoin miners, these are pretty common. People are looking at these and trading these. You can see there's a lot of open interest. Another one, of course, is like GameStop, just because there's so much interest on it. So these are all like good stocks to wheel. But at the end of the day, you do want to pick wisely, and price matters. So you always want to make sure that you are buying a company that you want to own for the long term. You don't necessarily mind if it goes lower, because when you are selling these options, you are always lowering your cost basis, right? So every time that 30 days goes by, I should collect $800, and my share position which my cost basis is $14.55, but I'm collecting that 80 cents. So like every time that I can do this, my cost basis is going lower and lower and lower and lower. And so you can see here that after 29 days, my share position goes from $14,550, but I just collected those $800. Now I own 1,000 shares of SoFi for $13,750, which is this amount minus the premium that I collected against these shares. And so you can see that if I continue to do this, say I'm successful and I can do this 5 times, well, now I've made $4,000 in 5 months. So you can see how that this can snowball and compound, and really you're in the game of accumulation. You never really want to lose your shares. And in another video, I'll talk a bit more about how you can protect it, right? So you're probably wondering, well, if I sold a $17 strike, but then on February 5th, it is at $18. Well, what do I do, right? Well, you're underwater. You're going to lose those 1,000 shares by February 7th because the current price is above the strike price. And what you can do is you can roll that contract. And I'll talk a bit more about this in detail in another video, but I think that was enough for this one. I hope you enjoyed. The market's going to be open tomorrow. We're going to be trading. Let's see if we can make some money, and I'll see you in the next video, guys. Peace.